Hi, and welcome to the latest episode of Vantage Point, where today we're fortunate enough to be joined by Leo Barry, Portfolio Manager at Fairview Equity Partners. Leo's pathway into funds management is anything but typical, from growing up on a farm in Deniliquin, country New South Wales, to a 15-year AFL career, including one of the most iconic grand final moments, before transitioning to markets via Merrill Lynch and ultimately to the buy side. Now over a decade at Fairview, he's part of a lean team running a long-standing small-cap fund with a disciplined, no-frills approach. In this episode, we unpack Fairview's investment process, lessons from past drawdowns, and Leo's view on small caps, liquidity, and more opportunities are emerging today. Leo Barry, you star. Always had to throw that one in there. Let's before we get started on the fund side, Nathan, my business partner, had one question to ask, just in terms of you as a 13-year-old in Denny.
Yes.
Have you grown since then?
I think I've actually shrunk. I've been the same height, 184, which is slightly over 6 foot since the age of 12. But that's when I used to play on the ruck and was one of the bigger kids.
Yeah,
but
probably man-child.
People have caught up pretty quick.
But let's talk serious. Obviously, footy. You retired at what, 32?
Yeah, about 32. Yeah, 15 years.
Be young to retire, or your body was cooked?
15 years. It's,
yeah, that's true.
Well and truly. No, I had a pretty degenerative knee. So I did my PCL when I was like 15, and so you don't get a
sort of man-child injury as well.
Yeah, one of those ones. Yeah, getting out of the car, driving. And so I was always mindful, and basically I was absolutely done by then.
Yeah.
And had quite a few.
Were Swans still up then, or not really?
What's that?
Were Swans still competitive then, or
we actually missed the finals in 2009.
Yeah.
But obviously, we had a really good list, and obviously won 2012, which wasn't that much long after.
Yeah,
Ruzi coached for one more year. I think it was one or two more years, and then handed over to John Longmire. So been a pretty consistent sort of coaching staff over there for quite a while.
And you used to work at Citi because they were a sponsor of the Swans. Is that how you sort of got in?
Like anything, I suppose. When the difficulty with footy, the longer you play, the harder it is to transition out into the workforce. And I always had an ambition of doing something different. So I always studied, and you're crazy. The AFLPA, they basically pay for your uni. So did an undergrad in sports science, and then did a master's in business, and then I started to do a couple of work placements. Wasn't getting paid, but Citi were a major sponsor, and getting an opportunity to sit on a desk is sort of hard, but you got to leverage off some of your contacts, especially in organisations. And as soon as I was on the floor, I just love the equity markets, and it's very much a sort of a team environment as well. A lot of the institutional brokers, and so every time I had a day off, I'd go in there. I didn't get paid, but just to try and learn all the different areas, and did it for about 4 years. Absolutely loved it. And so that really sort of helped me sort of gauge which area I wanted to be involved in, and also really developed a passion for markets, so to speak.
I've heard you talk about trying to get a full-time gig, which was pretty hard by the sounds of it in terms of a shitload of interviews, the market. It was just GFC. Do you reckon that sort of helped you long-term? That, I spoke to Juddy last week, and he's had it pretty sweet.
Absolutely. No, he's done well, Chris.
But just in terms of, not coming too easy and having to fight for it and learning.
Yeah, it's one of those things, I suppose. Footy's great, and I was fortunate enough to play for a long period of time, but it's very competitive, and it's hard. And I suppose that sort of level of competitiveness, it sort of stands true in any form of work or life, I suppose. So, and I was always, ambitious to do something after footy. Loved my time and my experience and what I learnt through that period. We did have some success. Early days it was sort of a bit up and down, but and then I knocked on a lot of doors. This was in my last year, and fortunate enough, you sort of need someone to give you a break, and I did. I got a break at Merrill Lynch on their sales desk. Still very raw. I had a lot to learn, but fast learner, work hard, and I really enjoyed my time there.
And why go to the buy side? Just hungry, competitive?
It's interesting I suppose going on the sell side for an institutional sales, you cover a lot of different accounts, and so I ended up gravitating to the small cap side of the market, and sort of spoke to all the small cap managers, some really, really good guys to talk to, and still friends with them and peers today. But also just the dynamic nature of some of the small caps, some of the really early stage businesses that, you can sort of see the growth that they can provide versus, the banks and BHP and Rio. So, it was really exciting for me. And our Fairview, they're a Melbourne-based fund. They offered me a job a bit over 11 years ago and still there, and really enjoy the day-to-day nuances of markets. And there's always something going on. And obviously at the moment it's pretty volatile, to say the least. But, it's a good little business and really enjoy what I do.
It's probably not the right term for a little business nowadays. You guys are doing really well. There's 4 of you now?
Yeah, there's 3 of us. So the 3 founders started the business in 2008. There's myself, Ben Chan and Tim Hall, just the 3 of us. In Sydney, I do our distribution, or MLC. It's business has been running for sort of 19 years. Probably one of the longest sort of running small cap funds in the Australian market. We're 100% retail. Returns are pretty good. We're in the sort of top quartile over most of the periods. They can, fluctuate. And I suppose for us, it's just the daily. There's always a scoreboard, and you always got to, try to continue to perform. And it's a tough industry, and it's competitive. And we certainly try our best for unit holders.
And funds management is often seen as glitzy and glamorous. And when the fund's performing well, we've spoken a little bit of late in terms of market's volatile. Some other funds are under a bit of pressure, unfortunately. You've been there. How do you sort of look back at that now? When was that, and sort of what did that look like?
Yeah, we had a tough period, 2016. There was a big drawdown in small caps. We probably mismanaged a little bit the liquidity element to small caps, and I think we had 30% of our fund was sub 500 mil market cap, and when there's a drawdown, there's obviously the term lobster pot, where you can't get out of a particular stock, and that was certainly the case. We also had one of our larger stocks underperform significantly, but I suppose from that day it was you have your high watermarks, you have to get back there, and it took quite a while. But like anything, we've certainly learnt lessons from that. In the fund, we can own 20% of the fund can be mid cap, but it's traditionally about 9 to 11%. But now under that 500 mil market cap, it's basically between 1 to 3%. So we've certainly learned our lessons from that. Got back to our sort of high watermark, and you got to learn those. And you're always learning lessons. But like anything, if you continue to do the same thing, you'll get the same results. So you have to change things to make sure you're really efficient. And especially in small caps, you generally make for us anyway, we make a lot of our alpha from our key positions in our top 10, which that's where you have your high conviction, better liquidity, and also. Because you have a higher conviction on your thesis of that particular idea, that's reflected in the weighting in your portfolio.
And then if we talk about the sort of liquidity in 2016, you probably positioned well in this current market in terms of learning from that lesson. Like small caps were absolutely motoring last year as a place to be.
We've been part of the pitch. It's since COVID, it underperformed by 30-35% versus the top 100. And generally in markets, when market sentiment's really bullish, interest rates are obviously low, people sometimes transition into small caps. And I think we outperformed small caps by about 16% last calendar year. Clearly what's happened, people get nervous. They flock to liquidity, better earnings visibility, perceptually, I suppose. And so you get some of the money just transitioning either back into cash or the banks, where some people sort of hide. So CBA and a few of those names, which has been the case. So it might be an interesting year for small caps. It's the market's obviously having a pretty tough month of it this month. We're down sort of 12%. But in saying that, for us anyway, we invest in resources. So that's something that it's 30 to 35% of the index at any particular time. So not just doing industrials, it can be sometimes difficult to keep up with the market. And even before the last couple of years, gold's been a really good performer for us, and I think it's been the best returning sector for us as a firm over the 18-year journey. And we just keep stuff really, really simple in resources. I'm certainly not a GO, but it's about just getting around, seeing management, seeing the companies, going to check out assets, and and it's a pretty simple model. Good jurisdiction, good management, high grade, low end of the cash curve, and increased production profile. And they're the sort of things that we really look for in any resource company, and that's sort of stood the time with share performance. And a couple of names like we own De Grey, which got bought, Tier 1 asset, and also Spartan, which Ramilius bought last year. really high grade, good management, and they really tick all those boxes.
And how much of resources would make up roughly of the portfolio?
It's about we're slightly underweight the resource sector at the moment. It'd be about sort of 29% at this stage. We're slightly, if you include energy, we're slightly underweight energy. Oil and gas is the hardest sector to make a return, and even I suppose in small caps, and it's really topical at the moment because obviously the issues with oil supply through because of the war with Iran, but the depth of quality sort of names it's hard, and so there's been a few hiccups and trips along the way. So we're underweight that, but we do have some other exposure to offset that.
Maybe talk stock specific. Codan's one close to our hearts.
Yep.
Maybe just talk about the journey there in terms of, I know you were there early days or probably 10 years ago.
Yep.
Sold out, re-entered.
Yeah.
Just talk about that sort of as a case study.
Yeah. And so this is often the thing and we've got examples of stocks we've looked at for 8 years. And it's when something changes and it's what's a key catalyst or a reason to own a stock. We don't buy stuff just because it's cheap. You have to identify something that'll re-rate the stock positively, but also even on the negative side, you got to have really, really good sell discipline. So you can't get wedded to stuff. So, the history of Codan, we owned it when it was just a mine lab just doing metal detection for gold. Sales absolutely exploded through Africa. They had a really, really strong IP around that. Unfortunately, their IP had been able to, it wasn't encrypted, and so some of these Chinese distributors and manufacturers actually were able to copy some of their product. Subsequently, it had a big run up, sold the stock, and we've been keeping an eye on the stock for a number of years. And then they bought two businesses called Zetron and DTC. So Zetron's it's basically for first responders in the US. It's basically the communications center, which uses a similar wave technology as also DTC. And I suppose the Ukrainian wars really lit a fire under DTC's business. They do the communication, which can't be hacked for a lot of the drone companies. And so Ukraine, there's basically nearly 2,000 drone companies that have sort of been created like this. And because of their wave technology, they're the global leader. Sales have been really, really strong. And I suppose having these other businesses made the business a lot more predictable because you have the volatility just around just doing the mine lab sales. So, not every business is flying at the moment, but I think we entered the stock probably about 2 years ago at $4, and I think it's sitting about 35. So it's been a really, really good investment for us.
And I remember, in terms of when you sort of had a real crack, it was after the Kooyong Tennis Day with Alf. How important is it, those sort of, not necessarily junkets, but just being able to meet someone, like an Alf who's done amazingly well. Obviously, that was before he was delivering. But ripping bloke. What you see is what you get. Understanding, the way he ticks and being able to have that confidence in backing the person as well as investment thesis.
That's probably the beauty of small caps. You get access to CEOs, management a lot more than you do maybe mid cap and also your top 100. So they really manage their messaging really well. They have an internal IR or an investment team that sort of manages where consensus is or the analysts, and also getting access to the people is really hard. And so that's the beauty of small caps. And that's why as a manager, you always have an edge over ETFs or a lot of the passive money, because we can actually sit in front and we have 600 meetings a year, which is, it's really a beauty of the job. Like we meet some really inspirational people that have created a business from nothing to, a top 100 or global leaders. And so that's a real benefit of the job. And I suppose part of our job is the analytical work, that is part of it, but also the soft skills and understanding the company, and also having trust in the management. And that's something that's we take really, really seriously as well. And some companies we might see 12 times a year. So you get a really good, number one, you can really build good relationships and rapport for good managers, but also, once again, you can identify what the next catalyst is to re-rate or de-rate a particular stock. So we're always active. Our turnover is about 70%. So we're certainly not a set and forget type fund.
And in terms of the investment process, you talk about, there's three of you, sort of goes to a vote and whatnot. It's one page. If it's not that simple, then you probably shouldn't own it.
That's right.
Has it changed at all over time? And when do you sort of look at changing that, or is there any lessons?
No, well, it's been refined over sort of nearly 19 years now, I suppose. I did sort of touch on the liquidity element. That is certainly one key focus, but it is pretty similar. And like we don't cover sectors. We cover everything. So we're generalists. So sometimes if you're just focusing on one particular sector, you get sectoral bias. And I might know more about a particular sector, but it mightn't be the best idea for the team or the fund and also unit holders. So we all have to know every stock, and we all have to vote and have at least a strong idea about a particular stock. And we have generally about 50 to 55 stocks in the fund at any given time. And we're all business owners, so we've got our own money in the fund as well. So, we have to work as a team, and you've got to work for and with each other and trust each other, but also test each other. Sometimes, ideas, of the 10 ideas that we get in the fund, there might be sort of 20 or 30 that are either knocked back or rejected. So it's about doing those preliminary work. And and a good example is Wagner's, which we've put in the portfolio just more recently, and that's a stock we've been watching since it IPO'd 8 years ago, and we just identified a couple of catalysts, being the Queensland Olympics. So they obviously do a lot of the quarry and cement work up in Queensland, but also just with their new power pole business, which they do have IP there, which it's replacing timber power poles, and they've already signed up a couple of the large utility companies in Queensland and looking to move over into the US.
And as a firm, in terms of sort of lessons, I'd say there'd probably be lessons every day.
Yeah.
What's sort of been if you're happy to talk to, the biggest sort of blow up or big mistake that, whether it's a position or something like that in terms of.
Yeah, it's hard to find a mistake, to be honest. No, that's a joke.
Classic way.
And this is the thing, you always make mistakes, and
that's why it's exciting.
And that's like on the sporting. If you're not making mistakes, you're not doing it. But if you don't learn from those mistakes, it makes it pretty hard. Look, the childcare sector is probably one. We've owned G8 on and off in the past. The aged care, that's been a really difficult one, which we continue to look at that sector as well. And a lot of those government funding businesses can sometimes be hard. We did invest in one particular sort of aged care business, and the meeting didn't go. I won't disclose what it was, but we found that they hadn't done the appropriate due diligence on acquisitions, and we sold straight away. It just showed the lack of insights, care, and also due diligence on buying assets. So it was more of a roll up. So that was probably a couple that come to mind, but also you can certainly see at the moment, just with the sell off in tech, the AI thematic has just exploded in the last 6 months, and some of the ideas which we had really high conviction about only 6 to 12 months ago, some of those stocks are off 50 to 80%. It's been a really swift move.
And when you talk to about emotional investing or certainly running a business, it's pretty hard not to let emotion come into it.
Yep.
When you lose money on a stock, and I've seen other funds that we've dusted cash here, we can't buy that again. And quite often, it's different if it's if they've lied or failed to deliver. How hard is it to go back and actually buy something that you've lost money on before?
Yeah, no, it's a good lesson, and you got to swallow your pride. It's you get better at as we go along, and even particular companies and management as well. That's probably the key one. If someone's really lied to you, there's a bit of a black book which you're always cognizant of, and if you are or you have a lower conviction, we just put it at a minimum weight of 50 basis points or 0.5%. So that is reflected in the size of the business, and we sort of run a bit of a longer tail. You can run, you could probably do more of a concentrated portfolio, but what it allows is, if we have a lower conviction on an idea, it allows us to take a small bet. We get better access to management, but also over time, our conviction can grow. Very rarely will a stock come in, like our largest active weight's about 5%. So we're nice and diverse, but it rarely comes in our top 10.
Yeah.
That's very rare. And so, unless there's a particular thematic we have to move fast, that's something we.
Do you find that hard to? I mean, again, it comes down to an investment process, but where you're super bullish on a company, and you're like, that this is going to, in your head properly rip, but it's like, let's just dip our toe in and test out the investment thesis.
Yeah, often the ones you get excited about are generally the really smaller ones, and this is the beauty of small caps. You can strip out so many unprofitable businesses, even in the miners. There's so many that aren't even producing. So often that can really refine or in the small odds, there's 200 stocks. Basically our investable universe is about 300 stocks. So you can exclude quite a few of them, and we screen a lot of those ones. But you have to really follow a lot of the businesses because they might acquire a business like Codan and it might really shape or change the strategy or the structure of the business. So that's something that you got to do, and that's all we do all day. And so it's part of it is the analytical work and always reading presentations, but also importantly, it's like getting out the road. And I was over in Perth only last week, and in that particular time, I reckon I would have seen 50 companies. So it's about that continual grind and talking to other industry bodies and a lot of your peers. You can get some interesting ideas and share ideas off some of your some of the other peers in the market. That's sort of where you can get your ideas.
And in terms of what's next for Fairview, you're just laser focused on small cap, right? You're not broadening.
Just try and
do what you're doing.
Yeah, well, our pitch is, you have the one team. If we open a micro cap fund, we'd be spending, I reckon, 60% of our time on that product. So when we see clients or people that have the money in the fund, we say we're spending 100% of our time on your product. And so, I think doing other products can dilute your focus. So at the moment, we just try and do that one thing well, and that's been the case for the last nearly 19 years.
And take us back to a little bit of diversion, but Denny, how'd you get out of Denny?
Great place to grow up.
Probably the second most famous Denny fund manager to come out.
Oh, well, that's debatable. Yeah, the other I'm not even going to mention it. No. But it's great. Mum and Dad grew up on a farm. Dad's a rice farmer and one of six. Mum and Dad, they sent all went to boarding school, so allowed us the opportunity to look at other stuff outside of Denny, which is very prudent. Mum and Dad are still in Denny, and subsequently none of us kids are there. And it was a great place to grow up on a farm, and learn some early lessons in life. And it was a good little town and a great place to visit.
Because you left home at what, like 14, 15?
Yeah, 15. So I went to Sydney. The Swans put me through school up in Sydney, and
and still on the board of the Swans.
No, I really enjoy. I love the club, and I spent some great years there, and even.
How long have you been on the board for now?
Probably about 7 years.
Yep.
Yeah. Myself and Michael O'Loughlin were past players, and it's a really good club. And I suppose when Ruzi came on board, we didn't have a lot of success through the 80s and also 90s, but to be a part of that real change in the culture of the club, which I was a part of, and have immense tremendous pride in the way the club is today, and we still have success, and that's down to what we sort of put in place. So to be still involved, it's great, and a lot of my mates are still involved at the club, and love the footy. Don't go to every game. I'm not a footy nuffy, but I'm really passionate about the Swans.
And thinking back to the Denny days, would you imagine that you'd be playing for the Swans, taking arguably the best mark ever, and now being a fund manager?
Yeah.
Probably
well,
not.
The fund manager one would that absolutely no. I didn't even know what a share was. But it's amazing where life can transition you. And as a kid, that's all I wanted to do was play footy, and played every different sport that I could. But footy was my niche, I suppose, and tried my best to get the most out of myself, which I thought I did, and then to transition into another really competitive industry. It's hard. It is really, really hard, but that's something I'm really proud of being able to do that. And often you get guys ask how to transition, and it's like anything. As I said, you can get your uni paid for, you can get everything done, but you got to ultimately you got to do it yourself.
You have to put the nuts on the line.
And you have to have ownership of yourself, and and set goals to drive that, and that's something that I certainly did.
And final question, just on Fairview, small team.
Yep.
Any views to expand that, or is that just overcomplicated?
You're trying to get a job.
I'm trying to get out of the industry.
Look, you always worry about. So I'm the longest there at Fairview now, and so the three founders have transitioned out of business of late. 3 is probably the right number at this stage. You're always keeping your eye on talent, and you just don't know where where someone might pop up. But at this stage, we're pretty comfortable with the 3.
It works well.
It does. Yeah. You got to get along. This is the other thing.
Yeah.
In small businesses, you all have to be on the same page. You all have to get on. You still have your robust discussions about stocks. You might have different views, but you have to be like a team, and you got to take feedback. You got to work, got to improve, work for and with each other. And
sounds like a roozy sort of thing.
Geez, yeah. No iron team. No iron.
Was it no dickhead policy his or?
Yeah, that was certainly part of it. And it's the old 80-20 rule. You spend 80% of your time on 20% or whatever that is rule. And so, Tim and Ben are really good guys, smart guys. They've worked on the sell side as well. So you actually get a balance of the whole market, which I think is really, really important. And that would be my advice to anyone. Going on the sell side, you have a lot of, sales trading, investment banking. There are a lot of different areas in an underlying bank and business. Private wealth's a really interesting sector at the moment, underserved. That's something that is interesting as well. So you get a broad-based idea about the broader market, and there are a lot of opportunities and what it fits for the individual.
Well, it's been a pleasure dealing with you. I think we met probably 13, 14 years ago at a cafe on the corner in Sydney. It's only grown since there, and great to see the success of the fund. Well done.
Thank you.
Cheers.